All right, welcome back. I hope you're having an awesome time so far. Our next speaker is Marina Kaganovich. She is the Director, Head of US CIB Digital Compliance at BNP Paribas. Please join me in welcoming Marina to our virtual stage.
Hi, everyone. My name is Marina Kaganovich. I'm a director in BNP Paribas Digital Compliance team, where I advise the firm on its digital initiative strategy with a focus on AI and robotics, collaborative platforms, privacy, and cybersecurity. Prior to joining BNP, I held a compliance advisory role in Goldman Sachs, where I supported the firm's IT and information security teams, among others. I'm thrilled to have the opportunity to speak about some exciting trends in the AI space, particularly as they relate to banking and financial services. What follows are my own views and do not represent the views of BNP Paribas. So to start, why AI? I came across an article published by Business Insider a few months ago that discussed the applications and benefits of AI in finance. The order of magnitude is telling. Within the next few years, the aggregate potential cost savings for banks from the use of AI applications is estimated at over $400 billion, and that figure doesn't take into account the revenue generating upside. Similarly, in an article written around the same time, McKinsey estimated that for global banking, AI-enabled technologies have the potential to deliver up to $1 trillion of value. With such tremendous potential, it's evident that the use of AI will be ever more pervasive and will revolutionize the financial services industry. I gave a talk a few months ago about the types of things that firms and compliance officers in particular should be thinking about when evaluating AI initiatives. It was heavily focused on data governance, testing, and interpretability, all of which are crucial to successful AI implementation. Today, however, I thought it would be interesting to discuss some promising use cases and then reflect on the regulatory considerations in this space that may be relevant. As you know, financial services is a highly competitive field, with firms racing to provide customers with new and improved capabilities in an effort to retain and expand market share while staying within the stringent and often prescriptive regulatory requirements to which they're subject as regulated entities, be it banks or broker-dealers, with obligations to contribute to safe, efficient, and secure financial markets. The ensuing discussion is aimed at addressing this intersection, which is often nuanced and difficult to navigate. So let's start with an overview of the many opportunities that AI has to offer. It's important to pause here and note that this is by no means an exhaustive list. Rather, I tried to take examples from multiple areas to demonstrate the breadth of this topic. They all relate to the provision and support for financial services, but from varying perspectives. So opportunities. This list is long, but by way of a few examples, AI can enable customized communications and marketing materials for better client engagement, virtual assistants to enhance client self-service, and sentiment analysis algorithms to assess customers' views. This is not a one-way street. Though financial services are always looking for ways to improve their offering and attract new clients, there is increasingly a growing expectation from clients that needs to be taken into account as well, where clients aren't viewing new digital offerings as amazing new innovations, but rather as an expected norm. Not meeting these expectations can have detrimental consequences to the relationship and result in client discontent and a loss of hard-earned market share. From an internal firm perspective, AI can be used for fraud detection as a means of measuring employee engagement and to affect operational efficiencies where there's a need, for instance, to analyze large data sets for a particular type of information. It also has applications in underwriting and credit analysis, sourcing and screening candidates during the recruitment process, and in Know Your Customer or KYC reviews. AI can enhance risk monitoring by enabling the assessment of data in novel ways and drawing insights that were previously unavailable. For instance, AI can be leveraged to inform capital optimization and stress testing, as well as for completely different use cases, such as to gauge the success of marketing or communication initiatives. As AI enables predictive analytics based on a client's past behavior, it may also help anticipate interest in a particular product or service or signal a change that may result in a price movement. In all of these examples, there is a use case for leveraging AI to sift through large data sets, identifying anomalies in structured and unstructured content, and automating manual repetitive tasks to bring about time savings and reductions in error rates. Importantly, the point is not to eliminate the human element from these reviews, but rather to leverage AI as an effective tool to identify trends and flag anomalies so that the human engagement in these activities is more meaningful from a cognitive perspective by tying in multiple sources of data to build a more holistic and complete profile and better inform the overall assessment. As an aside, and by way of clarification, the objectives I just mentioned are met through a variety of techniques, including natural language processing, machine learning, robotic process automation, and computer vision. For purposes of this discussion, however, I include these together under the general AI umbrella and focus on the results that these algorithms enable rather than on their particular functionality. There are also tremendous opportunities for the use of AI in the regulatory supervision and surveillance space, where AI can be leveraged to support a human reviewer by weeding out false positives, highlighting areas of higher risk based on predetermined thresholds, and supplementing potentially incomplete data to bolster the human reviewer's ability to make an informed decision on the information they're seeing. AI can also find patterns that humans may miss or which may not be intuitive, but are nevertheless telling. It's also worth mentioning the benefits AI enables from a cybersecurity perspective, which is particularly relevant now as so many firms have large portions of their workforce working remotely as a result of the COVID-19 pandemic, which resulted in a lightning speed shift that has certainly heralded significant enhancements from a technological perspective, but has also seen a commensurate rise in the level of risk that comes with remote working and the concern around safeguarding information in a non-traditional office environment. The prevalence of phishing and ransom attacks has risen, and AI can be used to successfully identify and thwart such efforts, as well as to yield insights into emerging threats that may otherwise go unnoticed. AI can also be useful in evaluating credit requests and in the hiring process, though it's not without pitfalls, which we'll discuss in a little bit. Finally, there are opportunities for the use of AI in biometrics and security as a means of user authentication through facial recognition, as well as voice and fingerprint recognition, not just in existing applications, such as when logging onto your bank account or from your phone, but also in a not too distant future where virtual reality goggles may be the new way of working and will require a secure means of authentication. This trend has been hastened by the mass shift to remote working, which has increased firms' level of comfort with operating remotely while simultaneously underscoring the information security risks that arise from such arrangements. And on that note, let's segue from the opportunities to the risks that should be considered in assessing the use of AI within financial services. Commensurate with the increased reliance on AI, there's been a corresponding rise in scrutiny and an emphasis on ensuring that AI is working as intended. AI-generated decisions are not necessarily based on the same determining factors that a human would use and may be biased or result in discriminatory outcomes. By its nature, when an algorithm is trained on historical data, it's inherently imbued with data that's skewed to some extent and is reflective of the norms that existed at the point in time when such data was gathered. As a result, it may be biased, and the parameters causing that bias may not always be apparent. By way of example, over the last few years, certain of AI's unintended consequences have made headlines. One situation that comes to mind is regarding the extension of credit when evaluating credit card applications. In this instance, smaller lines of credit were routinely extended to women than to men. Upon investigation, it was discovered that the algorithm lacked transparency, and though its results were apparent, the tie-in to gender was not, as the algorithm hadn't even been provided with gender information, specifically with a view to avoiding gender-based bias. Clearly, this was not a situation of intentional bias. In fact, in addition to removing certain data points from the AI's training set, the bank which issued the credit card also had the algorithm audited by a third party prior to releasing it. Nevertheless, the issue made headlines and impacted the reputations of the firms that were involved. This scenario illustrates the need to consider quote-unquote out-of-the-box possibilities where bias can result, and after steps are taken to prevent it. One such possibility, as noted by Wired when reporting on this topic, was the use of proxies by which gender could be inferred and still impact on the algorithm's decision, even when gender data points weren't included in the data set. Another example of gender-based unintended consequences was reported in the news a few years ago as it pertained to a company's use of an AI algorithm to vet candidates in an effort to help identify those who possess the background and experience similar to prior successful hires. Gender bias crept in here as well, with a disproportionate number of male candidates identified by the AI for further consideration. Upon review, it was noted that the algorithm had been trained on data from the last decade or so, which reflected male dominance in the field. Again, though not intentional, the gender bias was further precipitated by the algorithm, even though it wasn't an explicit criteria that the algorithm had been trained on. Notably, the inference from these examples is that AI is built in-house and that the firm that plans on using it has control over the data set that's used, as well as the manner by which the AI is trained. This is frequently not the case, with firms often opting to use a third-party developed tool where that third party potentially has more expertise in AI development. Regulated financial institutions are well aware of their responsibilities to its stakeholders and customers and perform due diligence on vendor tools prior to using them. However, the ability to look under the hood is often limited, as a third party has a right and an incentive to protect its intellectual property and would not expose the inner workings of the AI. Financial firms in that instance are unable to obtain a fulsome understanding of how the model works, and should they choose to proceed with the third-party solution, should therefore focus on verifying that the model is working as intended through rigorous testing and validation, that the outcomes generated by the AI are commensurate with those that a human would have reached in making a particular determination. Context is crucial, and this is an area where AI is often lacking relative to a human's intuitive understanding and review. Irrespective of whether built internally or purchased from a vendor, the examples we just talked about stress the importance of financial firms being able to explain how the AI reached the decision, even in situations where there's a lack of transparency into the underlying data set or training parameters. In addition to the business and reputational risks financial firms may face, applicable regulatory considerations should likewise be assessed. Regulators in the US and around the globe have taken notice of the prevalence of AI's use in financial services. In the US alone, the NYDFS, FINRA, and the US Department of Defense have published white papers and issued guidance in this space. Representatives from these agencies have given talks on this topic as well, and FINRA held a webcast in November, stressing both their own use of AI in market surveillance activities, as well as their understanding that firms are increasingly leveraging AI tools. They noted the importance of looking for bias, ensuring explainability, and considering privacy implications. Globally, the European Commission, ACPR, and Asian regulatory bodies have also issued white papers on AI. I mentioned these applications by way of example and note that there are many others. So let's take a few minutes and talk about the regulatory considerations that come to mind when developing and using AI. As a threshold matter, financial institutions are highly regulated and at all times must abide by the scope of regulatory requirements to which they are subject. For purposes of this discussion, I'll speak at a high level about the expectations of US regulators, namely those of FINRA and the Federal Reserve. It's important to note here that while the technology has evolved, many of the expectations are principles-based and as such aren't targeted to addressing a particular technology, but rather risks that may be posed to consumers and customers and to the integrity of the broader financial markets. It's useful to draw a parallel to other regulatory requirements that started with this type of general high-level approach and then developed over time into more stringent and prescriptive requirements, such as in the cybersecurity and data privacy arenas. So it may be that down the line, we see guidance that's more expressly tailored to the nuances and intricacies of AI. The Federal Reserve, or more colloquially, the Fed, has issued model risk management guidance and outsourcing guidelines that are directly on point for evaluating AI initiatives. From a model risk management perspective, firms are expected to undertake a risk-based approach that's commensurate with its other risk exposures, business activities, and the complexity of its AI models. The models should have detailed documentation that clearly articulates their purpose and scope to ensure that their development is aligned with their intended use. Additionally, the AI model methodology should be explained in detail to ensure that it's conceptually sound and statistically correct. The data used to develop the model should be rigorously assessed for quality and relevance, and following robust testing, the AI model should be validated via an independent review. All of these steps help confirm that the model is working as intended and assist firms in identifying compensating controls, which may serve to bolster confidence in the outcomes that are rendered. The Fed has also published guidance on managing outsourcing risk, which outlines the type of due diligence to which third parties should be subject, including onboarding and ongoing due diligence, contractual provisions, business continuity considerations, and oversight and monitoring. The model risk management guidance was issued in 2011, and the outsourcing guidance was published in 2013. So they were in effect well before AI became as prevalent as it is today, due in large part to the greater accessibility to big data and cloud computing. FINRA's paper on AI discusses the regulatory considerations firms should take into account, including market model risk management, data governance, customer privacy, and supervisory control systems. FINRA notes other factors for potential consideration also include cybersecurity, outsourcing and vendor management, and books and records. These are not new rules, but rather a tie-in of applicability to existing rules, such as those on supervisory oversight, conduct, safeguarding personal information, business continuity, trading-related controls, and many others. Though not expressly highlighting their applicability to AI, the requirements of these existing rules continue to apply irrespective of whether AI is used in support of these functions. Finally, privacy implications are a significant consideration. Firms should endeavor to cleanse personally identifiable information from data sets used to train the AI, and should ensure at the point of collection that the data's intended use is clear to the individuals from whom such data is being sought. Recent legislation in California, for example, as evidenced in the passage of the CCPA and the recently approved CPRA, makes this point abundantly clear and requires that businesses that collect personal information from California consumers articulate how the information is used and with whom it may be shared. Though the scope is most directly applicable to information collected from California consumers, these landmark laws are viewed by many as setting a standard in the US similar to the GDPRs in Europe, which likewise has requirements for transparent data processing, limitations on how personal data may be used, and the disclosure and consent requirements for its collection. So against this backdrop of potential opportunities, risks, and regulatory considerations, what's next? Well, the approach will depend on a company's structure, risk appetite, budget, and competing priorities. In my opinion, the first step is to identify where the AI use will be most impactful to the financial institution. A clear strategy with a well-articulated direction and associated budget for AI implementation, including a tiered list of priorities and a commitment to technology investment, is critically important. While undoubtedly requiring significant IT resourcing and investment, after all, absent a strong data governance or cloud infrastructure, the best intentioned implementation efforts may be rendered unsuccessful. The approach to AI should nonetheless ultimately be viewed as a business decision. The commitment to an AI strategy is also what differentiates firms who are serious about weaving AI use into the fabric of customer interactions and operations from those that treat it as a nice-to-have IT tool. Essentially, this becomes a matter of putting your money where your mouth is. Next, focus on delivery. Well-defined roles, responsibilities, and ownership are a must. This is essential since everyone has a million things they need to do. And absent a feeling of true ownership and accountability, AI initiatives may be deprioritized and are unlikely to efficiently move forward. Without identifying a person or team responsible for driving the AI initiatives, there's a high likelihood of delays and inefficiencies. As I noted a minute ago, use of AI is driven off business needs. So leadership in this space would ideally lie with a senior business executive who has a holistic view across the organization and can identify areas that would benefit from AI use, as well as partner with IT and data analytics teams who are integral in driving AI implementation. And finally, there's a need for a cohesive and engaged oversight body to support the identified business executive in the AI delivery. This multidisciplinary group can lend insights and varying perspectives from their respective areas of expertise, such as a point of escalation, serve as a point of escalation, and ensure that there isn't a duplication of efforts with teams working in silos. This group should include data scientists and engineers, as well as data governance teams who can speak to not only how data is used in modeling, but also its provenance, accuracy, and completeness. We've already mentioned the business and IT stakeholders, and others to consider depending on the organization's structure are representatives from compliance, legal, and risk teams to advise on the legal, regulatory, and risk management aspects of the AI's deployment. These steps are obviously at a high level, and a detailed project plan is needed, one that outlines the business requirements, technical specifications, legal and regulatory considerations, resourcing, timing, and budgets. A cohesive communication plan, both internally and to clients, should also be drafted to articulate what AI tools are available, how they're used, and how they were built. Clearly explaining these aspects, especially for firms where AI use is relatively new, goes a long way in ensuring transparency and ultimately garnering trust. These points are worth mentioning as the lack of a holistic strategy that's supported from a senior management perspective is ultimately detrimental to enabling digitalization and true AI leadership. Conversely, firms that take the time to consider where AI use may be beneficial position themselves as forward-thinking and digitally oriented, which in turn attracts customers and excited employees alike. So I think I'll stop there, though as you can see, this topic has many threads, each of which is worthy of exploration in further detail. Thank you for watching, and a huge thanks to AI4 for furthering the discussion of this complex and evolving topic, as well as for the opportunity to share my thoughts. For those who'd like to do a bit more reading on these topics, I've listed some of the sources that I've referred to in this talk. Thank you again for your time. I hope you found the talk informative.
Awesome, Marina. Thank you so much for sharing these insights with us. If you could stop sharing your screen so the audience can give you a big virtual round of applause. Wonderful. Thank you so much. We really appreciate it. All right, audience, it's time for you to make your way to your next session. So make sure that along the way you stop to accept your connection request and visit our awesome AI exhibits. Thanks so much, and we'll see you around.